Good evening and welcome to Miller Momentum. Before we get started, I am not yet a financial advisor, and everything in this video is for educational and entertainment purposes only. Okay, so I want to dig into why international stocks suck. Spoiler alert, they don't. It's often due to currency fluctuations. So, one thing to watch out for in international stocks is that you're not only at risk of different markets, you're also at risk of how the dollar performs relative to other currencies. So, right here, we've got the iShares Currency Hedged MSCI EAFE ETF. That's going to be your developed foreign markets versus the unhedged version of it. So, going down to our chart, we can see that the red EFA is a lot lower than the blue HEFA. What's going on here? Well, they're not holding any different stocks. What's happening here is about the value of the US dollar. So you can see, for instance, during 2022, when a lot of stuff was down, HEFA actually went up a little bit over the course of that year. And that's because international companies actually didn't do as bad as their American counterparts during 2022. What happened, though, is that the value of the US dollar relative to other currencies ripped upwards. So those international stocks cratered just as much as the domestic stock market. Because if you're, say, up 10% in euro terms, but the euro is down 5% compared to the US dollar, then your real gain comes out to be actually just around 5% instead of that initial 10%. If your international stocks are flat and the value of the dollar rises such that the local currency that your international stock is held in is 10% lower than the dollar, then you lost money relative to the dollar. And since most investors that are watching this channel are probably in the United States, that's a valid concern to take into consideration. So if you're taking on international exposure, ask yourself, do you want just the diversification effects of the international stocks, in which case you might want to investigate a hedged fund to hedge that currency risk. But if you want to also make a bet that perhaps the US dollar might fall, you want to go with an unhedged international stock holding. A VXUS from Vanguard is unhedged. Most international funds are unhedged because the point of holding them is if the US economy goes to pot, you want your international holdings to go through the roof to compensate. And that's part of why during the so-called lost decade of the year 2000 to 2010, international stocks did very well. That was not all just due to, foreign markets waking up and having great years. It was also due to the fact that the value of the dollar kind of went off a cliff. And so, relative to other currencies, it wasn't as valuable. So, your international holdings became more valuable because of those currency fluctuations. So, keep that in mind. As you can see, compared to the S&P 500, the hedge developed international market was actually just doing right on par with the S&P 500 through 2023. Of course, that's since diverged now, but if you were putting $1,800 into your portfolio every quarter, it's worth noting that right here with this hedged fund, distinguish it from a hedge fund, mind you. It is a hedged fund, not a hedge fund. You can see that it is right about where the S&P 500 is for a while. And now, the unhedged version of international equities will rise above the S&P 500 at different points, but it's just worth noting that when people point out the consistent underperformance of international stocks, a lot of that is due to the dollar just having an amazing bull run over the past few decades. And so, if you want to get an actual idea of how the international market is doing, and it's actually fairly comparable to the domestic one, then you just hedge out the currency risk, and there you go. Now, I personally don't like hedging out the currency risk because I think that there are better ways to get a higher return and with an unhedged fund, and also still have the benefit of having that fund rip way higher if the dollar ever does have a devaluation trend. And periodically it will. It's inevitable. So here's IDMO, the International Developed Market Momentum Fund from Invesco in green. And you can see here that if you had been putting $1,800 into that quarterly since uh, May of 2019, then even though this fund is unhedged, and so part of its returns get eaten away by the strength of the US dollar relative to other currencies, look at what happens here recently. It's actually gotten up to right about where the S&P 500 is. In fact, right now, this theoretical portfolio of a single fund would be at $111,000 roundabouts, whereas the S&P 500 would be at $108,600 roundabout. So when, not if, but when the US dollar's value collapses for a while, IDMO is going to rip upward not only from momentum, where it's already competing neck and neck with the S&P 500, but it's also going to get that rocket fuel from local currencies suddenly becoming more valuable than the US dollar. So that's what I wanted to share with you, and just dive into international equities because currency hedging and currency fluctuation and foreign exchange rates are something that I don't really hear a lot about on YouTube when people are talking about international equities, and they're essential to understanding how international equities work in your portfolio, why they may be underperforming, at least for the past decade, and why that might or might not be a problem for you. So thank you for watching. Please don't forget to like and subscribe, and let's get rolling with Miller Momentum. Catch you next time.